So an email from a subscriber and Twitter comments. So I was thinking about doing a video earlier, completely different topic, and what I'm going to be doing today after having a discussion with Jay earlier today. I got an idea on something I should do, and it actually would also answer what is going on in the market today. At the same time, I need to answer what these questions are, because people are seeing that, we turned bullish from 15,200, 18,000, then it went down. We were bearish again. We thought it'll fall a lot. US markets made a new low. India did not. So we turned bullish again, but people are unhappy now. They're unhappy because it didn't fall too much. And so therefore now there's a missed out feeling. That's about how I can look at this entire idea. And then if we are still calling this a bear market rally, but we are also turning bullish. So this is creating confusion. What's the confusion in all this? Now think about it. I don't know when you started investing, because see, there's a primary reason why I don't give an advisory service, because I've realized over time that I cannot expect everybody to do exactly as I do. So this video, hopefully, maybe I'll even put it on YouTube, so it won't be only a subscriber video. And so my belief is that people cannot exactly mimic. They will, even if they could, they won't, because it's just humanly not possible. You have your own view, and so you'll say, this guy is going to be wrong, I won't do this. And if I was wrong the last 3 times, I'll not follow him, and so on and so forth. I've seen this over and over in my working career, where we've been involved with clients so many times, whether you run advisory, PMS, whatever. People's panic reactions on the smallest drawdown is very, very high. So I found that always when I handle my own money, I have a much higher return and much better prospects than when I ever try to do it for someone else, because they always interfere and intervene and make sure that the end results are not good. The system ensures that rules come into place, rules that, okay, we should not do this or not do this, not have so much exposure, blah, 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 blah. And all of those things make sure that you will not have optimal performance. When I do it for myself, I'm not answerable to anybody. I don't share my portfolio. I don't tell you how much I've invested in what, even if I generally give you an idea. I actually prefer not to. We shared a little bit more of my positioning in the last 6 months to help people understand. But I'm sure most people can't even turn as I did, because at 15.2, I even wrote that I went back from 85% cash back to being 80% invested. And then at 17,300, 400, 500, I kept getting out because we didn't know what is the risk of the downside. So now why all of this? Well, I got invested in March 2020 and then May 2020 completely, from all fronts, all possible ways. And I've been, trading the long side and being bullish all the way till April of 2021. So that's a very, very 22. So that's like almost 2 years. And in those 2 years, index goes from 7,000 to 18,000. Everybody knows I wrote the reflation trade. Metal stocks went up 6-fold, 8-fold. So imagine you have that kind of return in your portfolio. Okay. So if you have a 10x return on your portfolio, let's presume. Okay. I'm not even saying I have or don't have. I think just presume 6 fix. Okay. Whatever it is, doesn't matter. Whatever is the return, it's going to be more than index if you had a fair number of good stocks, not only in metals. If you had Tata Power, Tata Chem, whatever, you add up any, if you just had Tata Group, okay. So if you have a fair good of return, what would you want to do today? You want to participate in the last 10%, last 20%. You want to be sure, you want to protect your capital or not. So if it's going to go from 18,000, you think this rally is only going to 20,000. This is your view. This is for which you want me to get bullish. Or you want me to say the market will be bullish for the next 2 years. It doesn't matter whether it's 18, 20 or 24. But for the next 2 years, it will make higher highs and higher lows. Then does it matter what is the level? No, because stocks will do better than index. You own stocks, you make money. What is the problem? So this whole mess of thinking about, whether you're bullish, bearish, bear market rally, this is all nonsense. In the end, you need a trending good market like you had for the last 2 years. The question is, are you out of that? My monthly RMI is in sell mode. My weekly RMI is in sell mode. So I'm not sure you're out of that. Yes, sometimes RMI momentum indicators can give false signals. Markets can extend. So then we look for extension signals. Extension signals can happen if either moving averages hold. We are seeing a whipsaw with the monthly moving average both ways. So it has gone below, then back above. So, and then we look for micro indicators, right? We like to see, are world markets in a bear market? Are interest rates doing? What are inflation doing? What is the dollar doing? So you're trying to discount it from various different angles, trying to think, okay, whether this can go into the next phase. Unless you get a sure shot confirmation, either based on the momentum trade setup or based on something else, why should we say that this is something else? So you deal with it accordingly. And that's what I'm doing. I get in, I get out, I get in, I get out. But now I want to come to the other part, which I was discussing with Jay. So now if people got the hang of what I'm doing, we are bullish right now. We think the market will overshoot because everybody was short at 17,000. So good place to start investing and trading long. Yes, if you did, great. If you didn't, you're probably complaining and telling me I was too bearish, and you listened to it and got out of the market, and now you're not able to participate. Now that is an emotional and psychological issue if you don't have a process of being able to deal with how the market is moving. But there's another way you can do it, which is that if you had stocks which had done really well over this last 2-year, 3-year period, you wouldn't get out of them. See, out of every 20 stocks you will own, I never own more than 20 in my portfolio. Some will do very well. There'll be some which are laggard, some which have gone up and start breaking weekly averages. This is what we train people to learn and do in the mentorship program. So those which are weakening, you remove from the portfolio and you hold rest. So you never go 100% cash. So depending on how many winners you have, and the reason I went more than normal cash is because many of my holdings were metals and cyclicals, which would be impacted by high interest rates. Now, if you owned other sectors, it would have done well. If you have followed my views, you'd also know that I was bullish on PSU stocks at point of time from October 20 onwards, saying that the worst is over. For entire 2 years, everybody disagreed. Why? Because stock market was doing well, metals were doing better than this, power companies were doing better than PSUs. Okay, but the reason to like PSU was they were basically had value. Okay, and they'd been through a long consolidation phase. Now what is happening last 6-8 months? PSUs are outperforming. But basically the reason is value versus growth. Growth stocks have taken the biggest hit in the world also. And our markets tend to mimic what is happening in the world. And what is happening with value stocks is they are holding out. And that is why you're seeing PSUs are in the value basket. I mean, when GAIL was at 150, not GAIL, sorry, Coal India. Okay, everybody hates Coal India. Sabse kharab coal banata hai. I think I mentioned it in Weekend with Indiacharts. And then I mentioned it also that, see, they're paying a 10% dividend yield. Okay, which is sort of the reason why after having to trade it long side many times, I actually ended up buying as an investment. So, the reason is that it was at 150 rupees, 10% dividend yield when they increased the dividend this year. So what can you lose? Bank is not paying 10%. Which is the same scenario which I faced with PSU banks in 2002 when I used to say just buy these PSU banks and forget it. Why? Because dividend yield is more than the bank and utta dividend yield hai to niche kitta jayega. There was no downside risk. So when you're playing the game of zero downside risk and unlimited upside. You don't know what will be the upside. If the economy turns very good, if it doesn't, you'll still get a trading gain. You can't lose money. Why wouldn't you get into an investment where you can't lose money? So that's sort of what value investing is all about. You find value. If you can structure that with your wave count and charts look good and there's momentum, all the better. So that is sort of what has happened with a lot of PSU stocks. But the PSU index has been gyrating in the same trading range now for almost 6-8 months. Okay, but some of the PSU stocks have done better than others, like Power Grid and so on, in between made new highs. Okay, coal has of course made new highs and so on. So this has been what has been happening. Okay, so now why am I talking of this? Because in this interim period, if you wanted to own something, you would be in defensive areas which are value, okay, or those which have fallen a lot and have reached an important support, a good retracement. Some have bounced back and done well. Some have actually still not bounced back in the mid caps. The setups are looking very good and they're still not moving even after the market's gone back to 18,000. So this is something which we are trying to deal with and see whether that bounce will happen in them because market keeps stretching higher, or will they not move at all. So there is a huge deviation between stocks, and so if you own a portfolio, some may be doing very well, the others may not do very well. You know, so that is why it doesn't really matter over here. Apart from trying to trade a move or get into a move or find winners, some of them. So if I buy 5 things and 2 things turn around and become winners, those are the 2 I'll continue to hold on to. The others which don't perform in this up move, I'll probably have to get rid of because when it starts falling again, I'm going to be at a loss. So these are strategies that you have to think of when you're in an indecisive stage, because some stocks will continue to do well because of growth, like they have been the defensive sector, right, which has done well. So anyway, now the value growth part is what I wanted to show through charts. So this is going to get chartical. So I'm going to shift to charts. I'm actually starting with the PSE index. This is the Nifty PSU index, where I was trying to think that the fifth wave ended at this bottom that you see over here. So which essentially is here, wave C, 5 of C, ending at a slightly higher bottom in October of 2020. That's what I just mentioned. And then from there, 1, 2, 3, 4, 5, 6, 7, 8, 9. Somewhere the fifth wave had to end, so possibly here. And then we're thinking whether, it's complete. And this is a broad range that you're actually seeing here. Okay, so this is what I was talking about. It's been in this broad range. So individual stocks have done better than others, specifically PSU banks have done better recently. And so a lot of variations in individual names, but broadly the index has done this. Now, what you would have thought if it's completed 5, okay, is this really a larger fifth? And then if it is a larger fifth, then are we really looking at a larger 1 and 2 kind of setup? So if this is 1, are we going to do a deeper 2, 61% retracement types scenario as you usually get? So that's something that we really have to think about. And then you can also have the argument that, okay, why can't it be over here? Why can't we be done with 2 and start a 1 and a 2? Now this is the scenario that we keep thinking about. But can it happen? So a year back, when I was more bullish, I was arguing it's possible. But at the same time, when we actually look back at the closest comparison to the kind of popping we've seen in US markets, it actually takes you all the way back to Y2K, the year 2000. Also a lot of similarities with year 2000 in terms of, what happened in sectors. Okay, so I don't know how many of you have listened to my recent interviews on Forex Analytics or the Traders Summit. We've spoken about some of those topics. In fact, in the Traders Summit, I went into the dollar wave to explain what really happened. But purely from an Indian context, during that 10-year period, 1992 to 2000, you had a long consolidation in multiple sectors. Okay, and after that, you had at the end of it, somewhere between 98 and 2000 is where the tech bubble really took hold. Of course, tech stocks were doing well all the way from 94. But just putting that in context. So what happened? Now let us just look at the Nifty. I'm opening several charts. Okay, what happened to the Nifty during that bubble and subsequent bear market? Okay, I'm going to just widen the Nifty. It went all the way up. Okay, so this is 1998. This is where the Pokhran blasts happened. People who don't remember. So they basically, it was the nuclear test bomb, and India became known to have nuclear capabilities. Market fell because of sanctions, ending diagonal formed, and the bull market took off from that ending diagonal because then the sanctions were slowly removed, and then of course it was the tech bubble taking hold. So tech stocks really did well over here, but this was also the orthodox bottom, as I should say, for a lot of the old economy stocks, which means and when we say old economy, what we're really referring to is cyclicals. Okay, so cyclicals meaning cement, power, capital goods, those kind of sectors, which were consolidating in the previous period. Yeah. What does that remind you of? 2020. What happened between, 2014, I think, or 2013 onwards. So 2011 all the way to 2020, what was happening was that many of the sectors, similarly in India, power, capital goods, were not making new highs. They were all stuck in trading ranges. But finally, after 2020, in that rally, they all broke out, which actually gives you a very similar setup like this. What really happened then is because of the rising dollar, the same thing happening right now, the US tech bubble popped and went into a bear market because they were raising rates into an overheating economy that caused the US bubble to pop. And then when it popped, it kept going down, and the Indian market also went along with it. Okay, as tech stocks got included in the index also tended to overreact. The Nifty actually made a higher high. Okay, because of less inclusion of tech pressure, unlike the Sensex, which made a lower low at this point of time. But what's important is that while many stocks like tech and mid cap, some of them related to those sectors crashed like 80-90%, some disappeared. The core sectors, which actually went up here in wave 1, which is again what I'm talking about is all your cement, capital goods, power, hardcore Reliance Industries, for example, and I look at those charts, they all did your initial waves, first and second waves through this bear market. Some of them even bottomed out very early, like Tata Power bottomed out here itself, BAIL bottomed out here itself, and then what did they do subsequent to that? ACC bottomed out here. So a lot of these stocks actually bottomed out within this phase. This was the bubbly phase, which occurred on huge volume, which is very similar to today, only difference being index is very close to the highs. Here it wasn't. But it was still bubbly because a lot of stocks were holding in the top range and, going through distributive patterns. Why did it appear bubbly? You can actually see it in the volume structure at the bottom. You see this volume structure, huge volume, lot of trading, lot of action happening through that phase. And so the reason is that a lot of stocks that had already bottomed early and from the core economic sectors, they did the initial first and second wave. So some of them did them here, 1 and 2. Some again did another 1 and 2. I'm going to show you those charts, so don't worry. Another 1 and 2. So the dates to remember are this top, which is around Feb to March of 2000. This bottom, which is around October of 2000. And then this final bottom, which is 9/11, the bomb blasts and the plane crashes of 9/11. And the bottom subsequent to that, which is September of 2001. Okay, so these are 3 important dates, and we see how different stocks behaved between that. And there are many of them which, bottomed out early and started to, trade in initial impulses, which is sort of the behavior I'm starting to expect now, which is where the value versus growth. So all those stocks were in value phase, which were actually doing that. Okay, so I recently opened the chart of ACC. Don't mind my black backgrounds. I don't have time to switch into white and black and show you. So you'll have to deal with it today. I'm not putting in that effort. But I think the charts fairly tell, this is that same time period. This is 98 to 2000. This is the bull run. Okay. And then the tech bubble peaks. This actually stock peaked in Jan itself. I think many of them between Jan and Feb were peaking out. But they bottomed out also early here in October of 2000, right? Halfway through that point. And then you had that huge volume rally. So what you actually ended up getting here is a series of 1s and 2s. Okay, this is what has ended up happening. Even though the index was making new lows, what you were seeing here is a series of 1s and 2s because the stock was back to replacement cost down here. You could replace an entire ACC at that valuation if you really could, invest in the infrastructure. So when you reach replacement cost, it's an extreme valuation situation down there. Over the years, that's what had happened. And it was true for many companies, including, say, a BHEL. So if I open the chart of BHEL and we're going to look at the same time horizon, I'm going to go right back. This is what has happened. I told you that this bottomed earlier in March of 2000 itself. Right at the beginning of the bear market, okay, within 2-3 months, this stock bottomed. What did it do after that? Higher high, higher low, higher high, higher low. Again, higher high, higher low. It just went on doing that. You can mark a series of 1, 2, 1, 2, as many times as you like inside this trading range. And this is sort of what it ended up doing, 3 times 1, 2s. And then it actually started its uptrend after 2003 when the bull market really took off. So what I'm trying to highlight, and there are so many. Reliance Industries is another. Reliance, for example, in the same time period, went all the way up here, made its highest point in February of 2001. Okay, so this up move didn't end with the Y2K bubble. It corrected a bit and then it went up. So it corrected sharply here, again bounced back, again corrected, made a higher bottom, again went up, made a new all-time high at that point of time in 2001. Okay, in March of that period. And then after March of 2001, it actually saw a correction, which is still barely, I think 50% retracement is all we must have got. I don't think we did even 61%. So let me just check on that. Yeah, we did do. At this low, we did do. Okay, so we did a 61 or more percent retracement. But main point being that all that happened only later. So what you got in many of these stocks, again, what I'm trying to highlight is a series of first and second waves. Okay, but they were impacted, throughout the bear market. Every time they tried to make, like you even made a new high in Reliance over here, it still came back. In the case of others, ACC made a new high in 2000, but not in the subsequent periods. But it still rallied many times, not making new lows through the bear market later on in the second half. And there can be many other such stocks. For example, I remember Tata Power doing the same thing. Okay. Now, why am I highlighting this? The point is it's going to happen. It may have happened in some cases at the June bottom. Okay. The only thing is we get scared. Even I get scared. I'm human. So I admit being scared. But I know that this happens, and therefore, wherever there is value, you have to step in and see. If you've bought something which is deep value and fallen a lot, and if it starts moving in your favor, you don't want to get out because you won't get that price again. That's my main point over here. Okay, so once you've had an entry at this price, you can try calling these pullbacks, but it's very hard, and then you may not get in again, and then you might lose out on the upside. If you can, then fine. But otherwise, this bottom also occurred in March, April of 2000, very early in the bear market, because this had gone down so much, it had reached an insane value. And so you ended up getting the subsequent initial impulse waves, both a series of ones and twos. This is throughout the bear market, and then these actual bull market starting only later on from here. The end of the bear market was actually September 2001. This is 9/11. So this is where 9/11 happened. So by that time, it did come down from the highs, but didn't make new lows below the previous low. So you get multiple entry points, but at the same time, you don't get the best price, which had already passed. Okay. So this kind of rotation, now of course, it's not going to be the same sectors. You don't expect Tata Power to do the same thing. This time around, Tata Power has been a top performer here. It was unlike what you saw prior to 19 up to 2000. It was actually in a bear market, which actually ended this time in this period itself. So it's not going to be exactly the same stock, same behavior, but you will see different stocks doing that kind of behavior. Now this may be doing your 1 and 2. We're still trying to anticipate that, and which is what we saw in the case of, say, Reliance. But there may be others which are going through a long grinding downturn, and then they'll pick up. Some may be doing may have already done the second waves by now. Their wave 2 may be complete, may have done 61% and may already be picking up. And even there, where certain pickups happen, we might see second wave declines. Okay, so I'm not getting into individual stocks because we don't want to make this a recommendation, but this is the observation. And there could be certain sectors that could completely plummet. For example, I would think FMCG is one of those which will eventually become a long underperformer, just like it did after 2000. So after 2020, I think you'll go through a 5-8 year period where the FMCG index actually underperforms. And so I've been talking about it in many of my interviews. So I'll just show the FMCG index. Okay. And in my long wave count on the FMCG index, I'm trying to mark an ending diagonal, because all the moves that I see here since this point are appearing corrective. 3, 3, 3, 3. So far this is 3, so still proven. And it has touched the trend line of all these highs. So actually taking it as an ending diagonal pattern till proven otherwise. And that only means that this is one sector that will go through a harder cut or longer duration correction, consolidation, just like it did in the preceding period. Here, although you do see some sort of a bull run here, actually most FMCGs, especially the MNCs, did not participate in the 2008 bull market, and only most of their rage came in this phase. This year, this index has done well mostly because of domestic FMCGs that were still in their infancy and were getting recognized as value. And so they drove the upside. That's how I remember it. And so that's my sense that, you're seeing a similar cyclical turn. A lot of the economic sectors have done well and have rallied in the last 2-3 years. If they correct, you'll only see second waves in them. And as and when those second waves are complete, you'll probably see them start off on the upside. So no, my long-term multi-year views have not changed. But you have to appreciate that second waves do happen, and they can be deep cuts, and that is the risk we are trying to mitigate or manage. So when we say bear market rally, we are simply saying bear market rally in the context of the rise that you've seen since 2020 in many of these sectors, which is a bull market. So only a retracement of that rise. Okay. If you can handle a retracement of the rise since 2020, then you don't have a problem. Okay. As a trader and market timer, I am trying to time that. Okay, if I've made gains still here, and if it's going to do a deeper retracement, I will try to manage that risk. So far, you haven't had a deeper retracement in the index. You have had it in individual stocks. So that you have to appreciate has happened. I tried to ignore that till here. After that, I'm not being ignorant. But at the same time, I'm not being ignorant of the idea that certain stocks and sectors will do well even in a falling market where there's value. And therefore, every time the market falls and I get a bullish signal, I am participating with my fingers crossed. So that's the current positioning. If the market gives me a buy signal and everybody is short at this bottom, why wouldn't I go long? And why wouldn't I do the same thing over here? Because we had the same kind of short squeeze situation. And you all know that I do a lot of intermarket analysis, which means when you see a new low over here in the US indices, but not a new low in the Nifty, of course, I recognize that as a bullish intermarket divergence, but that only means that you have an immediate bullish case. It doesn't mean that the long-term trends are changing. Not necessary. It could be, but not necessary. And so we need more. So for that, I need more confirmation. I just don't have enough to say that that is done. The Elliott wave structure of these moves is still not showing it. So everything is marked corrective. The momentum setups or somewhere in between, and so we don't have confirmation there either. And then we look at macro, where we don't have a reversal, but we have a lot of intermarket divergences. New highs in the dollar, not confirming new lows in certain markets. Commodities, copper didn't fall to a new low, but aluminium did. So again, that's a variation. So those kind of divergences have been there, which have at least led to us thinking that we have a near-term bounce rally, because if the higher bond yields and higher dollar are not impacting markets, which means probably the selling is overdone. But once we get that bounce, at some point of time, we have to reassess the entire situation. If the situation is the same, then we'll end up with the same results. But the thing, I think the main highlight of today's discussion is that, see, it's at a stock specific level, we'll have to be aware of things like value. So wherever you get a long correction, deep retracement, completion of Z or completion of 61% retracement, I would actually be interested in those kind of stocks, or something which has not moved and made multiple bottoms over the 2-year, 3-year period. I would be interested in that. And so that's where the selectivity will come in. And then after being selective, if that particular stock starts to perform in this type of market, that's something we hold on to, because all you will get is a wave 2 correction, not a new low. At the same time, you can manage risk. If you're good at timing exit and entry, then you manage risk out and in back into the same stocks. I mean, my list is not going to change in terms of my value wave thesis. What is value, and what's going to move, and what has done well will do well again. It's usually that way. What usually makes the first moves and starts doing well in the first run of a bull run, after the next correction, the same places end up doing even better in the future. So those are markets goes through 2-3 stages. One is the recognition phase, where we recognize what is going on, and then there's the actual phase where things play out in full scope in terms of the growth. So we are just in between that phase. We are in the place where world markets are correcting. Maybe even the US market is still not confirmed that it's not popped. It still looks like the Y2K bubble popped scenario. I've already explained that. So it's the same. And its impact on index was much more significant than on value stocks. And that is what I wanted to highlight today. And that's a variation that you need to really be aware of, that some stocks will fall less, some will fall more. And accordingly, you're going to get opportunities in each one, and you need to do as per your own portfolio. This is why I don't give advice. I've chosen not to do so that I can do what I want and what fits best to my case. It's not easy for everybody to mimic what I'm doing, and it's also there's a lot of mental work required in this, because entry, exit, if you're a long-term investor not used to doing that, you just buy and hold, you're not used to all this entry exit. So then you only look at and understand the overall scenario and act accordingly, and only hedge that much, or de-risk that much of your portfolio as is required. You don't really need to do what I'm doing. That's what I'm saying. A lot of people will complain about it because they'll not be able to follow both ways. But I have to assess risk based on what I'm doing and what I'm seeing. So while we do see strength in certain areas, we are not able to take risk off the table. And that's something I have to position for. I have to position for potential upside with major risk of downside still on the table. And if that positioning doesn't make people comfortable, I can't help it. So I've explained it. I've shown you what happened 20 years ago, and where the similarities are. As we say, history never repeats, it rhymes, and that is why it's not going to be the same stocks doing the same things. But you are seeing it in individual stocks and sectors where second waves are completing, and then they're suddenly taking off, and then the others which are still weak and have not completed the bear market, which are mostly the growth stocks of the previous phase. And that's the dynamic that you have to be careful of. I think the risk remains in the growth stocks, and not in the value stocks. Longer term, I think, even if you understand that much, you know what's going to work and what's not going to work. So do that analysis, and if you learn some amount of momentum analysis and multi-time frame analysis, you will be able to make a better judgment of what you should hold on to, not hold on to in terms of your long-term portfolio. In terms of trading, I don't think you've done pretty well, apart from I think the noise in between here where I was also not well, which was this part. And so I was getting a sense of whether this is an up-down market or still a trending bull market, was this phase. So this is where I got it wrong. If anybody wants to say, oh, where do you get it wrong, it's here. But most of the moves after that, I think I pretty much nailed it. I nailed this bottom, and then I nailed this bottom, I nailed this top, this bottom. Sort of we got most of these, plus or minus. I'm not saying exactly at the high. We would have exited only, we would have shorted it from here. I would have gotten out of my longs from here to here and added shorts and so on. And now we are bullish from here. Okay, so in fact, even when I came back from here, I was thinking it's going to go up, and it is going up. So now the question is, okay, how far is it going to go? And we don't want to turn early. See, that's the other problem. So at some point of time, if the view remains the same, we will find the market cool off and roll over, and we'll try to identify that turning point either early or soon enough, and then ride it on the way down. That is what our objective is. If something changes in the macro and momentum structure, we might give up and say, okay, we changed. But right now, I don't see reason to do that, and so I have not done it. But that doesn't mean I should not be positioned for what the market is doing right now. See, that is where the gap is between how I think about it, because having seen it for so long, there's too much variation that happens in sectors and stocks, as we have seen in the last year, which was also the reason why I was not giving up the bullish stance here, is because of the same variation that you're seeing today, which some people are finding troubling, is the reason I was holding on, because many sectors and stocks were holding on. That time people were complaining that, a lot of small caps are giving up, and you're not paying attention to that. So it's half glass full, half glass empty. You take what you need to. So if you're in this kind of a market, which is half glass full and half glass empty, you'll really have to filter out based on actual momentum readings across sectors or stocks, which ones you want to be in and which ones you don't want to be in. And that learning and ability to do it yourself is going to be critical, because we can do only so much. The rest of it is you have to do it for yourself, because we are not an advisory service. So that's all in this update. I'm sure a lot of people will have taken away a lot of knowledge and understanding from what I've really shared with you today. And between me starting this update and now, you can actually see this room's gotten darker. Either somebody switched off the light, or it just became a little night. So there. So that's it in this update. I wait for responses on this. I hope it clarifies people's minds in terms of where we are, what we are thinking, and why we have to think about it this way. Why I am thinking about it this way, why it fits my risk structure and my current situation based on what I have done over the last 2 years. You have to think where you came in. If you entered the market at a different level, your portfolio positioning, your sense of whether you want to participate, not participate, risk you want to take. That's a judgment I cannot really make, because that only an advisor can do. So then you contact an advisor who does your KYC, knows your position, knows your ability, and he can only tell you what to do. I cannot tell you. I can only share my opinion of the situation based on what I am doing, and hopefully you find that useful to enhance your knowledge and your ability to use the same tools and metrics. We are going to, in fact, I wanted to make sentiment indicators onto our platform, which I publish from time to time. We are now creating a completely new tool, which it's going to move on to, which Chavan is working on. So that will have the sentiment indicators along with many other stuff, many other things, scans of various types, things presented in a more accurate way from how traders would really want to use it, which we don't see on other platforms. So we're going to really make it very, very different, and very, very useful, utility wise, that everybody should want to have it. So anybody has inputs on what we should include in something like a screener tool, not just, I shouldn't even call it a screener, but really something which has multiple angles of studying the market and giving you data, either chartically or visually compelling ways to filter down to the best ideas that we should really be focusing on in terms of our research outlook. So that's what the tool intends to help you do, is you really drill down to the best ideas that you should be looking at based on whatever data and inputs are coming in from the market, and should hopefully be ready in a month or two. Let's see. We are deadlining the end of November, but I hope we can meet that deadline. It stretches a little more. Sometimes these things do. Maybe it will be a newer gift to everyone. So that's the next thing to really look forward to. So let me end this video update from me right now, Sunday, the 30th of October. and I'll see you all next time. Thank you.